Imagine working hard for 30, 40 years. Saving every single dollar you could. Giving up dinners out, family trips, and small luxuries. All to make sure your future was secure. You did everything right. You put your money into a traditional retirement account. Watched the balance grow slowly. And felt a sense of relief, thinking you would be protected when old age arrived. But now, there is a silent expiration date approaching on your calendar. A date that most people ignore, until it is too late. If you are over 60. There is an IRS rule you need to understand immediately. Before you blow out the candles on your 73rd birthday. This is not one of those ordinary tax rules that only changes a few dollars on your annual tax return. We are talking about a strict government law that can, literally, confiscate a quarter of the money you saved for the rest of your life. Simply because you made a date mistake. If you want to protect the wealth it took a lifetime to build. Pay close attention over the next few minutes. What you discover today could be the difference between a peaceful retirement and an unexpected tax nightmare. To understand the gravity of this rule, let us look at the story of a man named John. John retired at age 65. He had accumulated $400,000 in his traditional retirement plan. The famous 401k. He felt safe. John planned to leave that money untouched. Growing silently in the market. While he used other, smaller income sources to cover his basic daily expenses. He thought, this money is mine. I worked for it. And I will only withdraw it when I really need to. That was John's first, and most dangerous mistake. He did not know that, upon reaching age 73, his freedom of choice over his own money disappeared completely under tax law. When John turned 73, he did not make any withdrawals from his 401k. Because, in that specific year, his expenses were under control and he did not need the money. Months later, he received a letter in an official envelope. The sender was the IRS. When he opened the paper, John's stomach sank. He discovered that the government was not just charging the normal tax on the money he should have withdrawn. The IRS was applying a heavy punitive fine. A direct penalty on the amount he left untouched. The practical impact on John's life was devastating. He had to withdraw a significant portion of his savings just to pay a late penalty, drastically reducing the lifespan of his financial reserve. All because he assumed the money in his private account was 100% his to control whenever he wanted. But what, exactly, is this rule that caught John by surprise? It goes by a three-letter acronym that every retiree should know, RMD. Required Minimum Distributions. To understand the RMD, we need to go back in time and understand the original agreement you made with the government. When you first opened your retirement account, during all those years you contributed to a traditional 401k or traditional IRA. The government allowed you to do something incredible. You did not pay taxes on that money at the time. Every time you deposited $1,000, that amount came out of your gross salary before the tax bite could happen. Your money grew tax-free for decades. But the IRS never forgets a debt. To the government, delaying the tax was not a permanent gift. It was just a loan of time. And the deadline for that loan, now, is set by law at 73 years of age. The RMD is simply the tool the government uses to say, no more waiting, we want our share of the taxes now. Starting at age 73. You are required by law to withdraw a specific percentage of your total retirement balance every year. Whether you need that money to survive, or not. To understand the real impact of this on your pocket, let us compare two very different paths. On one side, we have Scenario A, the planned path. In this scenario, the retiree knows exactly when they turn 73. They look at their life expectancy table provided by the IRS. Calculate the exact amount they are required to withdraw. And make the withdrawal before the December 31st deadline. They receive the money in their regular checking account, pay the standard income tax on the withdrawal, and can use the rest for their expenses, or even reinvest the net amount into a regular brokerage account. Their wealth only suffers the impact of the normal tax they knew they would have to pay one day. Now, look at scenario B, the careless path. In this scenario, the retiree forgets the deadline, or miscalculates the required minimum amount, failing to withdraw, for example, $10,000 of the amount required by the IRS. What happens next is not just a friendly reminder of late taxes. The IRS applies a 25% penalty on every single dollar that should have been withdrawn and was not. On those $10,000 left forgotten in the account, the direct penalty is $2,500. That is money thrown straight into the trash. An amount that will never return to that retiree's wallet. And although this penalty can be reduced to 10% if you correct the mistake quickly, the stress, the bureaucracy, and the initial financial loss remain a heavy blow to bear. But the complications of the RMD go far beyond just a penalty for forgetting. There is an even more silent trap that catches even the most organized retirees. When you withdraw the required money from your traditional 401k, that withdrawal is not treated as a simple bank transfer. To the IRS, every dollar withdrawn from your traditional retirement account is considered ordinary taxable income. This means the amount withdrawn is added to any other income you have, like your monthly Social Security payments, or any private pension. If you have a sizable retirement account, your required withdrawal could be $20, $30, or even $50,000 in a single year. And here lies the danger. This sudden increase in your declared annual income can push you into a much higher tax bracket. Suddenly, you are not just paying taxes on the retirement withdrawal itself. All of your other income, including your Social Security benefits, now gets taxed at a higher rate. In addition, a higher declared income can trigger automatic increases in your monthly Medicare premiums, under a rule known as IRMAA. Do you see the financial snowball that a simple required withdrawal can create? Without careful planning years before turning 73, the IRS rule can sabotage your entire retirement cost structure. Fortunately, you are not completely out of options. There are legal and smart strategies you can adopt today, while you still have time, to disarm this tax bomb before you turn 73. The first highly valuable strategy is the Roth IRA conversion. Unlike traditional accounts, Roth IRA accounts are funded with money that has already been taxed before being deposited. Because of this, they have an incredible superpower. They are not subject to RMD rules during your lifetime. If you convert parts of your traditional IRA to a Roth IRA gradually throughout your 60s, you will pay the taxes owed now. But you will protect that capital from forced withdrawals in the future. Another excellent alternative for those who wish to support important causes is the Qualified Charitable Distribution, or QCD. If you donate your RMD amount directly to a registered charity, the IRS allows you to exclude that amount from your annual taxable income. You satisfy the withdrawal obligation, help those in need, and prevent your income tax from rising to a dangerous bracket. The most important thing is not to wait until the year you turn 73 to start thinking about this. Successful tax planning in retirement is a long-term game of chess, where every move must be calculated years in advance. In the end, retirement should be the most peaceful period of your journey. A time to harvest the fruits of decades of dedication. Not to live in fear of government letters or confiscatory fines. But ignorance of the system's rules is the biggest enemy of your financial peace. The IRS has its rules written in stone. And it is up to us to know them to protect what is rightfully ours. Take a moment this week to look over your accounts. Check your milestone ages. And speak with a tax planning professional if needed. Do not let a bureaucratic slip fade the brightness of your golden years. After all, the money you saved is the guarantee of your freedom. And keeping that freedom under your full control is the most valuable decision you can make today. If you are over 50 and want to learn how to avoid the hidden retirement traps, the ones most people only discover too late, subscribe to the Money After 50 channel. Share this video with someone who also needs to protect their savings. Thank you for watching. And we will see you in the next warning.